a modern economy. And you really can't have a modern economy without a well-functioning financial system. And that's why I've been very critical. It's because I think the financial system, the banks are really having a very important role to play, but they didn't do that. Their roles are actually fairly simple. Their role is to allocate capital, manage risk, run a payments mechanism, and to do this at very low cost. That's what we mean by efficient, doing all this at low cost. Well, our financial system didn't allocate capital, it misallocated capital. There was all the flow of funds that could have gone to make our economy more productive, and what it did is they allocated all of that capital to poor Americans, particularly, but other Americans, for homes beyond their ability to pay. It didn't manage risk, it created risk. The derivatives, which could have been used, or financial innovations that could have been used to help manage risk, were actually used to help exacerbate risk. But meanwhile, while they weren't doing what they were, these essential functions, they were garnering huge amounts of money. 40% of all corporate profits in the United States in the years before the crisis were in the financial sector. Now, the financial sector is a means to an end. It's supposed to make, you don't wear finance, you don't eat it. The role of finance is to make the rest of our economy more efficient. The role of finance is by allocating capital more efficiently, by absorbing risk. It allows other people to undertake more risk, higher return investments. And the principle is that in return for providing these core services, they get a fraction of the increment in the societal efficiency that results from their activities. But in fact, they didn't perform these functions, and yet they garnered for themselves 40% of all corporate profits. So in a sense, we were confusing means with ends. They became an end in themselves. Well, in a sense, the question I want to ask in the beginning is, what does modern economic theory have to say about all of this? Actually, a quarter century before the crisis, modern economic theory had argued that Adam Smith was, let me put it mildly, wrong. Now, obviously he had a very important insight that the pursuit of self-interest provides, these incentives are very important. But the statement that he made was not that they were part of making an economy work, but that they led to an efficient allocation of resources. They led to what economists call Pareto efficiency. Nobody could be made better off without making somebody else worse off. To put it one way, what our research on the functioning of an economy with imperfect information, asymmetric information, imperfect risk markets, the basic result was that the reason that the invisible hand often seems invisible is that it's not there. To put it another way, that in general, the market economy is not efficient. And that's particularly true in those sectors like finance where information is very important. And what that says is that in these particular particular sectors, there's a need for government regulation or some other form of intervention. So that's why for a modern society to function, there needs to be a balance between the market and the government. There is a need for, the government can't do it. That was a lesson from the Soviet experiment. It didn't work. It put too much reliance on government. It didn't focus enough on incentives, the message of Adam Smith. But what the crisis should have taught us that the other extreme, the view of, you might say, of Reagan and Margaret Thatcher was also wrong. That relying just on markets also won't work. You need, in these particular areas, there's an important role for government or some kind of collective action to ensure that markets work well. What I'm going to describe now are some of the very particular kinds of reasons that the market doesn't work well in the financial sector. And that leads to the question of what kinds of regulations can be used to help the market system perform better. So that's the structure of where we're going to go. Well, it's not surprising that government needs to play a more important role in the financial sector because market failures of the kind I'm going to be talking about are more important where information is imperfect, where there are important information asymmetries. The role of government is not so important, is not necessary in steel and lots of other areas where these information problems are not so paramount. I mean, there's still information problems. There may be problems of making sure that the product is what it's supposed to be. There are safety issues. There's still other issues, but they're not as central to the performance of the sector. Well, there are two important problems that are posed by the first is called agency issues, and the second are a whole variety of externalities. The agency issue is very simple, that the people making the decisions do not bear all the consequences of the actions. They're making decisions on behalf of others. So one way of thinking about this is that our model of 19th century capitalism was that an individual owned his own firm, and if he made good decisions, his profits were high, he got the benefit. He made bad decisions, he made losses, and he bore the consequences. But in modern capitalism, a very large fraction of all production occurs in large corporations. The CEOs of these corporations don't bear the full consequences of the actions. Now, it is true that Hayward, the CEO of BP, was fired after he led to this $30 billion loss for his company, but he still was rewarded with a $20 million bonus for having his company lose $30 billion. So there is a disjunction there between private reward that he got and the consequences for his firms, the shareholders, the bondholders, and even more, of course, for society. And that's the externality problem that I'm going to talk about. This is a problem that economists and lawyers have become increasingly aware of. Famous book in the United States was written in the 1930s by Burrell and Means stressed the separation of ownership and control, so that the 19th century capitalism had shifted to a different form of capitalism. Well, since then, things have gotten even worse. Worse in the sense that they've changed, and the separation, the agency problem has gotten worse. The people who invest in these companies are, for the most part, not investing on their own behalf. They're investing on behalf of others. Much of the savings in our society goes through pension funds and other institutional investors. So the people who are making those decisions are not doing it on their own behalf, they're doing it on behalf of others. So the consequence of all of this is that in making those decisions, they may have incentives, but those incentives are not well aligned with those in whose behalf they are supposed to be acting. And the result of that, of course, is when there's this kind of misalignment, quite often they make decisions that are not in the interest of the shareholders or their bondholders. Quite clear in that in this crisis, the bank officials, some of the bank officials did very well.